Hello and welcome to another Global Macro Update.
Woo!
Going to start things off with a quick summary of some of the stories I'll be getting into today, starting with, of course, the U.S. inflation numbers, which came in higher than expected at 8.3% for headline and 6.3% for core.
God damn!
No bueno. And last week, the ECB raised interest rates by 75 basis points, and President Lagarde gave some concerning remarks. European energy companies secured bailout money from the government.
That was easy.
Canada announces an inflation relief package.
You're a fucking idiot.
The IMF discusses issuing emergency food aid.
Say what?
And Charles Schwab, Citadel, and Fidelity launch a crypto exchange. Exactly. But before I get into those, let's go over a quick recap of last week. So last week, Vice Chair Lael Brainard, second in command after Powell, gave a speech on the Fed's economic outlook and monetary policy, reaffirming the Fed's hawkish stance. China shut down dozens of cities and millions of citizens due to its COVID-0 policy.
Whoa.
The Japanese yen hit a fresh 24-year low. Russia said it would retaliate against the G7 oil price cap.
Oh, hell no!
And the Ethereum merge to proof of stake started and is currently underway.
Nice.
But with that out of the way, let's go ahead and transition to the stories of this week, starting with inflation. So here are the highlights from the BLS report. So the consumer price index for all urban consumers rose 0.1% in August. Over the last 12 months, the all items index increased 8.3% before seasonal adjustment. Increases in the shelter, food, and medical care indexes were the largest of many contributors to the broad-based monthly all items increase. These increases were mostly offset by a 10.6% decline in the gasoline index. So this is actually important to keep in mind because the gasoline index, or just energy in general, fell pretty substantially, and yet inflation still held strong. I mean, core inflation rose pretty significantly because it was 5.9% the previous month and 5.9% the month before that. And the 6.3% is a pretty meaningful increase, and just goes to show that a lot of these other items, other than energy, are gathering some steam, and that's definitely not good. It's showing that inflation is broadening to other baskets and a lot of stickier items like shelter. But let's carry on. So the index for all items less food and energy, which is core, rose 0.6% in August, a larger increase than in July. The indexes for shelter, medical care, household furnishings and operations, new vehicles, motor vehicle insurance, and education were among those that increased over the month. And then I'm just going to go over some of these items so you can get the specific numbers. So as I mentioned, the all items rose 0.1% and was 8.3 headline. Food inflation rose 0.8% month over month and reached 11.4% year over year, which I believe was like the largest increase since maybe like 79 or something like that, which,
Not crazy.
Exactly. And then energy was down 5% to 23.8. Obviously still pretty high, but it's all about rate of change, so it is declining. We'll see how long that holds, but that has been imagine if energy was holding steady or increasing right now, inflation would be out of control, even more so. So hopefully that doesn't turn around, but again, don't hold your breath. And then we have the core inflation numbers rose 0.6% to 6.3%. And shelter, which is part of core, biggest item, rose 0.7% month over month to 6.2% year over year. I believe that includes owner's equivalent rent and just regular rent. They rose at the same level, so there isn't really any discrepancy between the two. Just overall, shelter is pretty much rising in tandem with each other, all the different elements of shelter. And then medical care services, 0.8% month over month and 5.6% year over year. And I want to say one of the biggest takeaways from this was the food inflation. That's what most people have been talking about. So the food index increased 0.8% in August, the smallest monthly increase in that index since December 2021. But it did increase, like I said, 11.4% year over year, which still was the highest amount since I think it's 1979. Yeah, it says it right here. So the food at home index rose 13.5% over the last 12 months, the largest 12-month increase since that period, or the period ending March 1979, which is pretty wild. But yeah, that is pretty much it. There's nothing too much to go, or not too much more to go into. Obviously, dive into this yourself if you want to get a deeper insight into where the inflation is. But I would say the main takeaway from this is that inflation is spreading to other areas. And even though energy has declined meaningfully, like significantly, I mean, just over the month, down 5%, inflation is still increasing. I mean, core went up pretty substantially. So that is not good, and just really gives the Fed a green light to maintain its hawkish stance and raise interest rates aggressively. All right, but enough of that. Let's transition to the next story. So we had last week, Powell spoke at the CATO monetary conference, or something to that effect. Doesn't really matter. But I listened to the interview, and what was nice about this was it wasn't a written, rehearsed speech. Pretty much every speech that Powell gives, you just find the written version because it's pre-written, it's rehearsed. There isn't really like this candid back and forth, and that was different with this, which I thought was really important, and why I wanted to include it. Not anything super crazy, but I went through the whole conversation and took away some notes. So the pandemic is to blame. This is basically from Powell himself. The pandemic is to blame for the bulk of inflation, supply side problems.
Right.
And then in the 70s, the public's belief that inflation would persist led it to persist. This is something that the Fed chairs have been talking about a lot, how inflation expectations is one of the biggest problems. If people think inflation is going to be a problem, it will continue to be a problem. And so he's just reiterating that. And then the longer inflation remains elevated, the greater the chance it remains sticky. And part of that ties into expectations. If inflation is around for a long time, people kind of normalize it and think it's just going to be the new reality. And that kind of anchors inflation expectations higher than normal. The Fed's goal is to achieve growth below trend to get wages and inflation back down toward its 2% target. So this is the Fed's way of saying they want to hurt the economy and they want to achieve growth below trend. That is essentially their goal. He's basically saying their goal is to create a recession or severe economic maybe not severe, but an economic downturn that drives wages down and inflation with it. So, I mean, it's pretty fun. I mean, they have their ways of saying it where it doesn't, read between the lines. But the Fed's goal is to achieve growth below trend. That's very rare that you see that, but that is the world that we live in.
Not crazy.
And the Fed's balance sheet expansion through QE is less of a factor in inflation than supply and demand. Now, a lot of people might push back on this, but I personally agree. I think people don't really understand exactly what QE is and does. It's more of an asset swap than anything. I'm not going to get into this today. I have a whole video on it if you want to check out the my YouTube channel, the Market Taker series. But so it's funny. I actually admired this about him, saying the Fed balance sheet expansion through QE is less of a factor in inflation than people think. It's more to do with supply and demand. Very rarely do you see that kind of candor come from a Fed chair. But anyway, I digress. Moving on, non-monetary factors like the business cycle drive the labor market, which makes it more difficult for the Fed to affect. So he's flat out saying that the tools that the Fed has aren't really that good at affecting labor. It's more to do with a lot of non-monetary factors, just the natural ebbs and flow of the business cycle. So again, the Fed and Powell acknowledging that the tools that they have at their disposal are not exactly ideal for tackling the problems in front of them, which, I mean, obviously that's a problem because they are, trying to kill the economy to solve these problems. And if they don't have the tools to do that, it just doesn't really make sense.
Totally.
And then Powell doesn't see a return to a scarce reserve regime. And what he means by this is in the modern era, really recent modern era of, the global financial system and the U.S. in particular, banks have been flush with reserves, primarily because of QE. And that's what QE is. The bank prints bank reserves and exchanges those for something like treasuries or mortgage-backed securities from banks. And in this modern era, banks have been absolutely flush with reserves. And I guess through quantitative tightening is how they reduce those reserves, because the Fed, gets those reserves back, exchanges the mortgage-backed security or the treasury, whatever it is. They give it back to the bank, take those reserves, and essentially just get rid of them. And so the reserve balance for banks, the cash reserve balance, or bank reserves rather, just goes down. And we haven't lived in a scarce reserve regime in a very long time. And he's saying that he doesn't see that returning, or us going back to that. He says that, I guess to add some context, he talked about how where we are right now is working, and having the banks flush with reserves is fine. There's no reason to go back to a place where there aren't as many reserves, or reserve liquidity is a little bit less abundant. But anyway, so next point. The Fed doesn't want a world where privacy protection is jeopardized through a CBDC. So this has been a big concern, because CBDCs definitely do grant governments, or whatever central authority is kind of issuing that CBDC, they grant them a lot of authority and oversight ability to kind of look at all the transactions that take place within that ledger, that network. And he was pretty flat out about this. I kind of respected it. He was saying that the Fed does not really want to jeopardize privacy. They aren't China, basically. They don't want to use this as a tool. They, I don't know. He just, I guess, flat out just said that they are not trying to abuse privacy, and they are really more interested in the technology, but they're taking their time on a CBDC. And then next, Powell doesn't see unbacked cryptocurrencies, which is, most of the cryptocurrencies, as a viable alternative to fiat. Says they are speculative assets.
Totally.
I disagree for Bitcoin, but anyway. But does see some merit in stablecoins, which would need to be regulated as any other form of money. Now, their interest in stablecoins is definitely aligned with their interest in CBDCs. It's just basically making a more streamlined digital version of the dollar. So obviously they're interested in it, but the Fed doesn't want to stifle innovation for that reason, because of things like stablecoins, or I guess for crypto more broadly, but particularly for stablecoins. And they are just encouraging appropriate regulation. At least that's what Powell's saying. And then finally, as I wrap this CATO speech up, 3 lessons that Powell has learned throughout his time as Fed chair. The Fed accepts responsibility for price stability. Inflation expectations are important and need to be monitored. And inflation must be tackled swiftly and fully, because it will come back with a vengeance if not taken out forcefully. And that was kind of the lesson of the 1970s, how you just got to tackle it once and make sure you squash it as hard as you can, because it will come back with a vengeance. And that's not what they want right now. They want to destroy inflation in one fell swoop. Again, we'll see if that happens. All right, so next story. So kind of in line with this conversation about inflation expectations, U.S. consumers' inflation expectations fell again. So U.S. consumers' inflation expectations slid further in August as gasoline prices extended their steep decline from June's record high, a development likely to be welcomed by Federal Reserve policymakers weighing how big an interest rate hike to deliver next week. Consumers in August saw inflation at 5.75% over the next 12 months, down from 6.2% in July and the lowest rate since October 2021. They also foresaw price increases averaging 2.8% over the next 3 years, the lowest pace since late 2020, after pegging inflation over that horizon at 3.2% in July. Moreover, consumers last month saw price increases running at 2% over the next 5 years, matching the Fed's own targeted inflation level. That was down from 2.35% in July and 3% at the start of the year, when the New York Fed first started asking about inflation expectations over that time frame. Those outcomes may bring some relief to U.S. central bank officials who have been fretting that the highest inflation in 40 years might alter consumers' perceptions of how sticky the current price shocks may be, which would make policymakers' job of containing inflation all the more difficult. So this is very good from the Fed's perspective because, as I've mentioned many a time, one of their main goals is really to manage people's expectations. They think if the public views inflation as out of control, it will continue to be out of control. So they are probably loving to see this. They want to see inflation expectations go down because they think that really leads to inflation itself going down, which again is not necessarily untrue. I just think they place a little bit too much weight on the expectation side, but that's probably because that is the only thing they can really do. Like I said, their tools don't really help them that much in terms of solving the problem in like a real way, but they can kind of do some psychological witchcraft, and they can affect people's expectations. That is probably their strongest tool, and so they're going to use it.
Totally.
So the Federal Open Market Committee, FOMC, is expected at its September 20th to 20. I don't know why they said it. I think it's September 21st meeting to raise the central bank's benchmark overnight lending rate again from the current range of 2.25 to 2.50. So that's what it is right now. Futures contracts tied to the Fed policy rate this month barely budged after the release of the New York Fed survey, as traders continued to overwhelmingly price in a third consecutive 75 basis point hike from the central bank next week. And actually, that has changed further after this most recent inflation, the CPI numbers came out. And I believe right now the market is pricing in a 70% chance of a 75 basis point hike and a 30% chance of a 100 basis point hike. Now, obviously, that can change at any day, any week, depending on more data or whatever. But it doesn't seem like 50 basis points is even on the table.
Damn!
All right, next story. Okay, so this was, from my perspective, kind of an out-of-the-blue story. Obviously, there was a lot going on before this. It's not like it just happened overnight, but I didn't hear about it until recently. So the U.S. government makes contingency plans for rail shutdown.
Huh?
So President Joe Biden's administration on Tuesday made contingency plans aiming to ensure deliveries of critical goods in the event of a shutdown of the U.S. rail system, while pressing railroads and unions to reach a deal to avoid a work stoppage affecting freight and passenger service. The potential shutdown, which could come as early as Friday, could freeze almost 30% of U.S. cargo shipments.
God damn!
Stoke inflation, impede supplies of food and fuel, cost the U.S. economy about $2 billion per day, and cause transportation woes.
Aww.
If agreements are not reached, there could be union strikes or employer lockouts, but the railroads and unions also could agree to stay at the bargaining table, or the Democratic-led U.S. Congress could intervene by extending talks or establishing settlement terms. The Biden administration's push comes as food, energy, automotive, and retail groups implore Congress to intervene, saying a rail shutdown could threaten everything from global grain supplies to shipments of goods related to Christmas holiday shopping. Yeah, in America, you don't fuck with Christmas.
Totally.
So the White House has told railroads and unions that a shutdown is unacceptable and will hurt American workers, families, and businesses, and they must take action to avert it. The U.S. energy sector relies on railroads to move coal, crude oil, ethanol, and other products. Now, this is important because I think a lot of people, railroads and trains, out of sight, out of mind. Most people probably think of this more of like an outdated form of transportation, but it is how a lot of things get moved still in this modern economy, and without them functioning normally, there are a lot of goods that we desperately need that won't get to the places we need them to be. So this is just going to potentially, I guess it's not for sure yet, but potentially add a lot more problems to this overall supply side, inflation, or just supply side bottlenecks. So some railroads plan to impose additional restrictions that could impact food suppliers and online retailers that use intermodal services that connect ships, trains, and trucks. BNSF, which serves the western United States, said it will stop accepting refrigerated intermodal cargo And then Norfolk Southern, which serves the eastern United States, said it will stop accepting all intermodal shipments. That has not happened since the early 1990s when Congress sent the parties into final and binding arbitration. So this is also being talked about today, as I think it talked about this article mentioned earlier, that Congress is potentially going to step in just because it's such a big problem, and it kind of, I think it has to do with it being interstate trade. Whenever things go from state to state, that's a federal thing, and so that it might be why Congress is intervening or expected to intervene. But that could be where we're headed to, that Congress needs to kind of solve this problem, resolve the problem between the unions and the railroads. So it takes about 4 trucks to handle cargo in a single rail car. Actually, let me add some context to this. So people are saying maybe we'll have to supplement these trains or these railways with just more truck drivers. And I think they've already put truck drivers on alert that we may need more truck drivers, more activity to make these shipments where the railroads can't, or the railways are clogged up or whatever, just not moving. But the problem is it's not really, it sounds good on paper, but it doesn't really work in practice. So it takes about 4 trucks to handle cargo in a single rail car. The United States does not have the estimated 467,000 trucks or the necessary labor to support such a shift. Beyond that, some cargo is just too heavy or large to travel over the road.
Yep.
A rail work stoppage could strike as U.S. farmers harvest corn, wheat, and soybeans for exports around the world, according to the National Grain and Feed Association. The economic damages across the food and agricultural supply chain would be swift and severe. So yeah, as if we needed one more issue on the supply side of things, but obviously this isn't for sure. That very well could come to some sort of agreement that resolves this and lets railways continue as normal, business as usual. But in the meantime, this is definitely a real concern because out of sight, out of mind. People don't think when they go into all these stores or wherever that all these goods, the coal that powers them or the other resources that help power these businesses, and all the goods that you're actually buying from those places, they come from somewhere, and a lot of times they have to be shipped via these railways or whatever. And so this is something that actually affects the overall economy in a very, very powerful way. All right, but a lot of happy stories today, guys. So let's transition to foreign markets, starting with Europe. Whoops. Okay, so actually I'm going to start off by just playing this video of Christine Lagarde, the ECB president, and her giving her own thoughts. So let's take a listen.
The Governing Council today decided to raise the 3 key ECB interest rates by 75 basis points. This major step frontloads the transition from the prevailing highly accommodative level of policy rates towards levels that will ensure the timely return of inflation to our 2% medium-term target. Based on our current assessment, over the next several meetings, we expect to raise interest rates further to dampen demand and guard against the risk of a persistent upward shift in inflation expectations. We will regularly re-evaluate our policy path in light of incoming information and the evolving inflation outlook. Our future policy rate decisions will continue to be data dependent and follow a meeting-by-meeting approach. We took today's decision and expect to raise interest rates further because inflation remains far too high and is likely to stay above our target for an extended period.
All right, yeah, crazy stuff. So I'm going to go through the rest. This right here was the beginning part, but I'm going to go ahead and go through the highlights for the rest of the speech. So looking ahead, ECB staff have significantly revised up their inflation projections, and inflation is now expected to average 8.1% in 2022, 5.5% in 2023, and 2.3% in 2024.
God
So this is big because the ECB is straight up just saying inflation is likely to get worse before it gets better. So after a rebound in the first half of 2022, recent data point to a substantial slowdown in euro area economic growth, with the economy expected to stagnate later in the year and in the first quarter of 2023. Staff now expect the economy to grow by 3.1% in 2022, 0.9% in 2023, and 1.9% in 2024. The labor market has remained robust, supporting economic activity. Employment increased by more than 600,000 people in the second quarter of 2022, and the unemployment rate stood at a historical low of 6.6% in July. Looking ahead, the slowing economy is likely to lead to some increase in the unemployment rate. Measures of underlying inflation remain at elevated levels, and no shit. And the latest staff projections see inflation excluding food and energy reaching 3.9% in 2022. I think, did she say this again? I don't know. I'll just read it just in case. 3.4% in 2023 and 2.3% in 2024. In the context of the slowing global economy, risks to growth are primarily on the downside, in particular in the near term. So she's putting it out there that, I mean, not that we didn't already know that the, Europe area is in a very difficult situation, but she's saying in the short to medium term, inflation concerns, the risk for inflation, the risk is on the upside, and for growth, the risk is to the downside. Basically saying the base case for both is in the opposite direction that they want it to be. So confidence could deteriorate further, and supply-side constraints could worsen again. Energy and food costs could also remain persistently higher than expected. Basically just painting the worst possible picture right now. I guess, if you prepare for the worst, the slightly better outcome than the worst possible outcome is an improvement, but it definitely sounds like she's not painting a very good picture. Very, very stark indeed. So the risks to the inflation outlook are primarily on the upside. In the same way as for growth, the major risk is in the short term is a further disruption of energy supplies. Over the medium term, inflation may turn out to be higher than expected because of a persistent worsening of the production capacity of the euro area economy. So the big part of this is obviously the energy, and with countries like Germany and others who have been able to be economic powerhouses, manufacturing powerhouses because of cheap energy. So if that cheap energy goes away, they cannot be nearly as productive. What they didn't really, they probably knew, but they didn't really prepare for this. Like, their whole economy was kind of based on cheap energy. And without that, they're just not the same. And so a worsening of the production capacity is very much likely unless they can secure cheaper energy, which doesn't seem like it's going to happen. Not that they won't be able to secure energy, because they are, taking steps to figure that out. They're, importing LNG from the liquefied natural gas from the U.S. and other places like Qatar, I believe. And they're, securing different energy resources from all over the place. They're trying to figure it out, and they very well may figure it out, secure enough energy to remain, stay alive, through the winter. But at the same time, that doesn't mean that they're going to secure cheap energy. And it's the cheap energy that has allowed them to excel. So, absent that cheap energy, we're probably going to see a lot of pain. And that is, no ifs, ands, or buts. She's not hiding behind any, euphemisms, really. She's flat out saying it, Lagarde, that this is not a good situation to be in, and most of the risks are to further worsening outcomes.
Aww.
So last little bit, our future policy rate decisions will continue to be data dependent and follow a meeting by meeting approach. We stand ready to adjust all of our instruments within our mandate to ensure that inflation returns to our medium term inflation target.
Right.
Now, one more bit about this that I wanted to mention. It was actually with the questions someone asked about quantitative tightening, and I believe Lagarde just said that they are not really considering it right now. So they're not considering reducing the size of their balance sheet, which is pretty substantial, especially when you got other places like the U.S. who are pretty adamant. They're not only doing it, but they're expediting that pace of quantitative tightening. And the ECB and Lagarde basically said that they will not be doing that. They don't plan to do quantitative tightening, in the meantime. So that was a big takeaway. Again, that was in the question section. If you want to dive through it, there actually were some good questions, but I'm not going to get into that right now. So let's go ahead and transition to the next story. All right, so last week talked about how the yen hit a 24-year low and was just being absolutely devastated. I mean, like year to date, it was down, against the dollar, like 30%, at least at the low point or the USD high point against the yen. And so there's actually been a little bit of backtrack. I'll still get into this article, but I think because this article, obviously the summary right here, analysis, Bank of Japan is nowhere near shifting monetary policy to support yen. But they have been making some comments. By them, I mean Bank of Japan officials like the finance minister and all that. They have been making some comments that they are concerned about the the foreign exchange rates, and that it may call for some sort of intervention. I think it's more of a bluff. I think they say this stuff. They try to steer away speculators and people, get people a little nervous. You're like, if they say something and insinuate that they may be willing to step in, that would kind of deter speculators from driving, down the Japanese yen. So that could be part of this. It's just kind of like a managing expectations psychology game. But let me go ahead and get into this article. So the yen may be near 24-year lows, but Japan's central bank is not even close to trying to support it with higher interest rates.
Not crazy.
So that actually that's probably true. Even if they do pivot, something tells me they will try to find some way around it that doesn't require them to adjust their yield curve control. Who knows what that's going to be? It's kind of like how the ECB had their little transmission anti-fragmentation thing while still raising interest rates and trying to be engaged in tighter monetary policy. So something tells me if they do pivot, so to speak, they might try to do something else, some kind of weird accounting thing. Who knows what it's going to be? But anyway, so that is the message from these three sources familiar with the thinking of the Bank of Japan. And it was strongly implied by the country's top foreign exchange diplomat last week, and indeed by central bank chief Kuroda. The government, especially the Ministry of Finance, has repeatedly and strongly expressed dissatisfaction with this year's fall in the yen. I mean, obviously, depreciated like 30%. Which on September 7th dropped as far as 144.99 against the dollar, down 30% since the end of 2021.
God damn!
That is huge for a major currency. So the Bank of Japan has no intention of raising interest rates or tweaking its dovish policy guidance to prop up the yen. The Bank of Japan won't directly target currency rates in guiding policy. It looks at yen moves in the context of how they affect the economy and prices. Now, that's not necessarily a bad way to view it, as long as the Japan economy is fine and the devaluing of the yen isn't severely hurting consumers. Then I suppose they don't necessarily have a real reason or the political pressure to pivot. And so that might be something to look at. I don't know if anyone has any resources, people in Japan they can talk to get kind of a boots on the ground view of how their economy is doing, to see if anyone there is starting to talk about like, hey, maybe we need to do something to bolster the yen because people can't afford things. I don't really know. I'd have to take a deep dive. I haven't looked into that in full disclosure, but that might be the move because Bank of Japan probably won't get that political pressure, the meaningful political pressure, because there might be political pressure from outsiders, foreigners, saying that they need to hold up the yen or whatever because of contagion risk, or I don't know, who knows. But in terms of the political pressure from within Japan, that might not really rise until the yen devalues to such an extent that it really becomes a problem for consumers. So, we'll see, but let's carry on. So, current economic conditions don't justify tweaking ultra-loose policy. So, according to the Bank of Japan, they aren't seeing that, on a local level that they need to pivot to, help consumers. So the Bank of Japan has joined the finance ministry in warning against sharp falls in the currency. But Kuroda said in July, it's hard to believe that just by raising rates somewhat, you can stop the yen's decline. When the Ministry of Finance expresses its displeasure with the yen's falls, it's said to be jawboning, dropping a hint that it may intervene in the market to support the currency. This is intended to make traders cautious in selling the yen.
Totally.
So this is kind of what I was saying earlier. They drop these little hints to deter speculators, deter people from, exacerbating that trend, but they don't necessarily have any real intention of changing their policy or their stance. They're just doing this to kind of slow the pace and to scare people, frighten them that a pivot might be coming, so they feel less inclined to take on that trade against the Bank of Japan. So the central bank is set to maintain ultra low interest rates and dovish policy guidance at its September 21st and 22 meeting. The Bank of Japan's dovish policy stance will come under the spotlight as European and U.S. central banks hike rates. The weak yen trend will continue. It could feel compelled to respond in the event of a freefall that became so extreme that the economy and price stability were threatened. That, however, is not the current situation. So, summary from this, Bank of Japan, it might be doing a little jawboning, trying to get people to stop, exacerbating this trend where the yen is depreciating. But as long as the local economy is fine and they don't see any, let's go back to it. As long as the economy and price stability were not threatened in an extreme or severe way, there is no reason to really intervene. So again, get some boots on the ground view of Japan to see if and when that might be coming. But I would say that the Bank of Japan is probably going to remain steadfast in their easy monetary policy. Again, not financial advice, but that is my contention at the moment. So moving on. So next story. Indian states step up relief measures for households battling inflation. So this is actually starting to become more and more I shouldn't say popular, but maybe more common, I guess. It's just happening more frequently now, where you have countries fighting inflation by sending relief packages, which, kind of doesn't really make sense. But anyway. So at least 10 Indian states have announced over 1 trillion rupees, equivalent to 12.6 billion, mainly in cash transfers and electricity subsidies for households to combat inflation, according to government officials. Local politicians are worried about the impact of sharp increase in prices on household essentials. For example, food inflation, which accounts for nearly 40% of the CPI basket, rose 7.62% year-on-year in August compared to a revised 6.69% in July. The northern state of Punjab and national capital Delhi recently announced 300 kilowatt hours of free electricity per household and free travel for women on state buses.
Damn!
So they're handing out handouts, which, as a general rule of thumb, doesn't usually help with inflation. I mean, if you are giving people free money, that makes them spend more money elsewhere because you're basically you're literally subsidizing them, and maybe it doesn't have an impact, but think about it. If you were going to spend that money on electricity, now the government is helping you out, you have more money now to spend on other things, which could help drive inflation because that increases the marginal buyer for whatever thing in the economy.
Totally.
So last week, the state government announced a jobs guarantee program for urban poor as part of its relief measures for households. Now, this is something that, a lot of people talk about it, but most notably, Jim Rickards, who is the author of Currency Wars, Aftermath, and a bunch of other books, he talks about how this is probably going to be how the government gets a universal basic income. It's going to be under the guise of a universal job guarantee program because that is more politically, palatable. People will be more willing to accept a guaranteed job than a, universal basic income. So I think this is a big deal because if the government starts guaranteeing a job, that's basically them guaranteeing an income, maybe benefits. And that is the start of this kind of quasi-universal basic income. So I think that's a pretty big deal right there. So the state government has announced free electricity supply of 50 units of electricity, not sure what that even means, 50 units, every month to all households. Many other states have also cut electricity tariffs and announced cash transfers for poor households. A study by the Research Department of the Reserve Bank of India in June estimated that 9 states in their annual budget this year said that 0.1% to 2.7% of state gross domestic product went to free items and services for citizens. Woo! That's pretty crazy. So up to 2.7% of GDP going to free services for citizens. That's a pretty meaningful amount. All right, and then final point. Annual consumer inflation rose to 7% in August, remaining above the tolerance band of the Reserve Bank of India's 2 to 6% target, which is pretty. I didn't realize it was up to 6%. That seems a little generous, and is projected to remain above 6% until March 2023. So, like many other places, India is projecting inflation to persist in a significant way leading into the next year, above 6% until March 2023. All right, so let's transition to another story of relief to combat inflation. So we have Canada's Trudeau announces $4.5 billion in Canadian dollars of inflation relief for low-income earners. So Canadian Prime Minister Justin Trudeau announced equivalent to $3.43 billion in measures on Tuesday intended to provide relief from high inflation to low-income families. The measures include doubling a quarterly tax credit sent to individuals and families with low and modest incomes to offset sales tax, and a Canadian $500 one-time top-up to housing benefit that is provided to low earners who need help with rent. And this is a quote, "These are things that will make a difference in people's lives right now, but they are also sufficiently targeted that we are confident that they will not contribute to increased inflation."
Right.
Now, I have my doubts. I mean, again, whenever you're giving someone handouts, you are basically giving them more money to spend on other things to drive up prices because they have more money they otherwise wouldn't had you not helped them. That can be spent elsewhere in the economy. So you're basically contributing to more spending in other areas by subsidizing these people who can't afford whatever it is. Not that you don't need help, but I don't think this is kind of like treating symptoms rather than causes. So while inflation cooled a bit in July from an almost 4-decade high of 8.1%, the Bank of Canada is still concerned about rising prices and is promising further interest rate hikes after increasing them to their highest level in 14 years last week. Derek Holt, head of capital markets economics at Scotia Bank, expects the stimulus will start being spent in the first and second quarter of 2023. And this is a quote, he said, "I would expect this to add to inflationary pressures into the start of the year," adding he anticipates that will increase the pressure upon the Bank of Canada to go over 4% with its policy rate. So over 4% terminal rates is becoming the norm now for a lot of central banks, maybe not the ECB, but for Canada and the US, possibly even like the Australian central bank. 4% was, like half a year ago out of the question, and now it's becoming maybe the expectation, maybe even a little bit higher to 4.25, 4.5, whatever it is. But yeah, battling inflation, and this is one of those have your cake, eat it too things. They're trying to raise interest rates aggressively to hurt the economy, and then they're simultaneously offering relief to help the people who are, can't weather that storm, which might exacerbate it. And I don't know, it's not a good situation to be in when you are trying to tighten monetary policy and you're so worried that the tightening monetary policy is affecting people so poorly that you are giving them, you're easing by giving them subsidies or some type of handout.
You're a fucking idiot.
Not the best picture of Trudeau. All right, so next story. So European energy groups secure government support amid cash crunch. So energy companies across Europe are turning to governments to bolster their liquidity and secure supplies as the gas crisis stoked by Russia's war against Ukraine tests their ability to stay afloat. Switzerland's largest renewable electricity producer, Axpo, and Finnish utility Fortum both said on Tuesday they had secured big new state-backed credit lines. Power producers across Europe are facing an acute cash crunch as sharply rising energy prices lead to ballooning collateral requirements on the futures exchanges where they hedge their supply contracts. So let me explain this real quick. So a lot of these power producers, they, that deal with commodities, because they're holding commodities, they have exposure to commodities, they will hedge that exposure, because by holding the commodities, they are long commodities like natural gas or whatever it is. To hedge that exposure, they will sell a futures contracts or forwards. And so when those futures contracts balloon dramatically, they basically get a margin call to post more collateral. And because of how much they ballooned their exposure to the, by selling their short exposure to these commodities, those forward contracts and futures contracts ballooned so much that they had to basically post more collateral than they really had. And so that led to this need for them to be bailed out, essentially. I think the futures contracts have retraced a decent amount. They got up to, like Germany, for example, I think energy forwards got up to like $1,000 per megawatt, equivalent to $1,000 per megawatt hour. And they have since retraced to like 406. Actually, it might be in euros. Doesn't really matter. Close enough. They're, euros at parity, so might as well be the same thing.
Totally.
But let's move on. So the Swiss government activated legislation to stabilize the finances of its energy companies at an emergency meeting of the governing federal council on Monday evening, following an urgent appeal by Axpo over the weekend. So we cannot afford for a large electricity company to become insolvent and take other companies with it. We want to prevent a wildfire by all means possible. There have never been such high jumps in prices in Europe as there are now. So the bailout comes with a high financial cost. The finance ministry said it would charge companies interest of 6 to 11% on emergency funding, a punitive rate that could wipe out annual profits for the companies should they fully utilize the available funds.
Little bitch.
So it's not without contingencies. So Switzerland is particularly vulnerable to turmoil in European energy markets this winter. The wealthy Alpine country's dependence on hydroelectricity means it must import up to 40% of its electricity needs during the colder months when lakes and rivers in the Alps freeze. So this credit line ensures that, should the situation intensify further, Axpo is in a position to cover the collateral requirements of long-term power supply contracts concluded with its customers and continue contributing to Switzerland's security of energy supply. So Finland and Sweden unveiled separate guarantee packages of up to 33 billion at the weekend to avert what the Finnish economy minister called all the ingredients for the energy sector's version of Lehman Brothers. So a lot of people have been talking about this or equating it to the Lehman crisis, just like the energy equivalent in Europe, because it is a big deal. I mean, all these people are struggling to remain solvent amid these rapidly increasing energy prices. And this is why they need the funding and potentially will continue to need funding if they struggle with insolvency going forward, which, again, is a decent possibility. So, illustrating the extreme volatility in the markets, Fordham said its collateral demand had fallen last week by $1.5 billion to $3.5 billion, after rising the week before by $1 billion. So, extremely volatile. It said a week ago that the Nordic market could collapse if there was a default of even a small utility.
Not crazy.
So Fordham needs to make use of at least $350 million from the liquidity facility by the end of September, otherwise it would end. And the liquidity cannot be used by Fordham's German subsidiary Uniper, which is the biggest natural gas company in Germany. It said it, and this is because it said it needs a bigger credit line after exhausting the one provided by the German state. So I found this crazy that Uniper is a subsidiary of Fordham, which is getting this, government handout. And one of the contingencies is that the liquidity given to them by the government cannot be used for that subsidiary in Germany, and which probably needs it more than any of them, to be honest. But the German government has already helped Uniper with offering some sort of credit line, and that will probably continue in the future. So last little bit. So Raramo, who that is, repeated his calls for regulatory changes to curb the unreasonably high margining and collateral requirements. He added that power companies should be able to use their future production as collateral so that companies, many of which are earning record profits, do not technically default due to margin calls. So this is like a huge deal. Germany is basically, or not Germany, well, Germany too, but Europe in general is going through a severe energy crisis, as we all know, and that is starting to really take its toll on businesses that are progressively moving into insolvency. All right, but next story. So this is not like a huge story, but more symbolic than anything, so I wanted to include it. So, lights out early for Eiffel Tower as Paris saves energy. For those who don't know, Europe in general has been promoting energy rationing, and this is just the latest iteration of that. So Paris will switch off the Eiffel Tower's lights an hour earlier than normal, lower the water temperature in municipal pools, and delay heating public buildings to save energy this winter, the city's mayor said on Tuesday. The measures are aimed at meeting President Emmanuel Macron's goal that industry, households, and municipal authorities reduce their energy consumption by 10% in response to Russia's cut to gas supplies and spiraling energy prices.
For real? You fuck with that?
So apparently the Eiffel Tower is going to go dark an hour early. What are we going to do, guys? But still, pretty crazy that, I mean, they're so desperate right now that they are turning the lights off on the Eiffel Tower early to ration power. I mean, if that's not a testament to the situation that France and other European countries are in, I don't know what is. So France is not as exposed to Russian gas as some neighbors, Germany, but a record number of nuclear reactor outages has forced France to import power when it would typically be an exporter, exacerbating the pressure on power markets. So I actually learned this not too long ago that France gets used to or get the majority of its power from nuclear. Maybe it was like 70 or maybe even like 90%. Ridiculous, and good for them. But I think they've struggled to maintain those nuclear reactors, and so, you know, basically they're not doing what they need to, which is supply energy. And so they're, you know, that lack of maintenance has led to a number of them, a number of outages in those nuclear reactors, and now forcing them to import power when they needed it most and needed to rely on that nuclear energy most, which is unfortunate. And then last, I just want to end on this quote because I thought it was funny. This is from the mayor of Paris. So France will always be the city of light, except when we shut the lights off. So it should not have ended with that. I mean, I get it, but at the same time, you're literally turning the lights off early. So anyway, so let's transition to the next story. All right, so IMF confirms plan to expand emergency aid to help countries deal with food shocks and shortages. Where's my stuff? So the fund had provided $27 billion in loans to 57 low-income countries and was continuing to encourage its member countries to come to us, IMF, early for needed financial support. The proposal discussed Monday would temporarily increase existing access limits and allow all member countries to borrow up to an additional 50% of their IMF quota under the IMF's rapid financing instrument, with low-income countries able to tap the rapid credit facility. So the plan, first reported by Reuters on Monday, would allow the IMF to provide additional unconditional emergency financing to countries hit hard by the food crisis unleashed by Russia's war. There is a sense that it is a necessity and we have urgency to act. What we are proposing is to increase access to emergency financing for a year to countries that are most vulnerable. So there has been a huge food shortage going on, and it will probably get worse just because there's been an even more severe, I would say, fertilizer shortage, and there is a lag effect. Obviously, you don't have fertilizer, you can't grow food, so the next year's crops or next season's crops are going to be have much smaller yields, or maybe even no yield if you weren't able to plant anything. And so this is becoming more and more of a problem, especially as we get further along this journey of lack of fertilizer, and these yields that we were supposed to have, we don't have. So we're reliant on the food we're growing right now for eating several months down the road or whatever it may be. And absent that fertilizer and the yields that we need to do that, we're going to have food shortages all over the place. And this is, I think, mostly affecting Africa, especially because they were the ones hit the hardest, I believe, by the Ukraine war. obviously Ukraine was the hardest, but you know what I mean. They were hit the hardest in terms of like the food not being exported because they were heavily reliant on Russian and Ukrainian wheat. But yeah, so the International Monetary Fund on Tuesday confirmed that it is moving toward expanding emergency financing for countries hit by surging food prices and shortages triggered by the war in Ukraine, with some 20 to 30 countries seen most in need. So yeah, basically, problems are getting worse, and the IMF is going to have to fund potentially a lot of, or like subsidize a lot of food purchases, or for like countries in Africa or wherever it may be, a lot of these poorer countries that are struggling to weather these food shortages. And the one thing that you really should keep in mind about the IMF is whenever they give some sort of funding to a country, it almost always comes with some sort of contingency. And most recently, those have been like ESG related things, and that actually is in large part, I would say, what led to the collapse of Sri Lanka. They gave them funding a while back, and basically the contingencies were to become like as ESG compliant as possible. And part of doing that was not using, I guess, like industrial fertilizers that require a certain amount of fossil fuels to like help that whole process. And that led to them having food shortages. So the irony, right? How it kind of leads into the other. But yeah, I'm curious to see what contingencies, if any, come with this, and that's something that I would follow. But yeah, food shortages are becoming a serious problem to such an extent that we have the IMF and potentially other countries being forced into contributing some sort of funding to help people eat.
Not crazy.
All right, so let's transition to, what are we on? Crypto. Okay, so as mentioned in the intro, Charles Schwab, Citadel, and Fidelity launched EDX Crypto Exchange.
Say what?
Yeah, I don't know what their intention is with this, but a group of investment firm giants, including Charles Schwab, Fidelity Digital Assets, today announced the launch of a new cryptocurrency exchange. Other backers include Citadel Securities, Paradigm, Sequoia Capital, and Virtue Financial. And other market participants are expected to partner with EDXM, the exchange, following the launch. The intention of the industry consortium is to build market infrastructure that contributes to increased optionality for liquidity to facilitate a more efficient, secure, and cost-effective process for trading digital assets, a Fidelity representative told Decrypt via email. So EDXM will serve both institutions and retail investors, giving them a safe entry point to crypto. Now, again, the specifics of this don't matter as much. I wanted to bring it up because this is huge in terms of big players. Charles Schwab and Fidelity, some of the biggest players in traditional finance. I mean, Fidelity has, I think, like trillions, maybe not trillions, I don't know. They have so much money under management just because of all the retirement accounts that are with them. So them entering the digital asset space, if they're having their own crypto exchange, I don't know, maybe they're going to introduce that to clients. That is potentially a lot of money that could pour into crypto. Just creating those gateways for people to actually buy assets in a safe, secure way.
Right.
And let's be honest, there already are safe and secure ways. They're just kind of advertising this. And honestly, the name brand thing is a big part of it because you got older people who, they're like Coinbase. I'm not going to buy from Coinbase. That seems so speculative. But then they see Fidelity and Charles Schwab. They're like, I know those names. I trust them. And so maybe they're more willing to buy. I don't know. Hard to get into the minds of people. But I think this is a big deal. I mean, them creating their own exchange, that's really validating the industry.
Totally.
All right, next story. So back to our favorite person, Justin Trudeau. All right, so Justin Trudeau slams conservative rivals' irresponsible Bitcoin views. So speaking in St. Andrews, New Brunswick, on Monday, Trudeau criticized his new political rival for his irresponsibility in promoting cryptocurrencies to his followers. So technically it's only Bitcoin. I'm sure I'll get into it, but he's just casting a very broad brush by saying cryptocurrencies. So telling people they can opt out of inflation by investing their savings in volatile cryptocurrencies is not responsible leadership. Anyone who followed that advice would have seen their life savings destroyed. Trudeau doubled down on this line of attack over Twitter, calling POWELL, that's the conservative rival that is a proponent of Bitcoin, so calling his support a questionable, reckless economic idea. Not that Trudeau doesn't have a lot of those. So Poilievre was elected as Canada's next conservative leader on Saturday in a landslide victory, scoring over 68% of the party vote. I mean, that's huge. That's wild. His runner-up, Jean Charest, only won about 16% of the vote.
Little bitch.
Yeah, sit down. So the conservative leader ran a campaign largely focused on fiscal responsibility and reducing inflation, especially as it relates to increases in the money supply. And this is a quote from him: "Government is ruining the Canadian dollar, so Canadians should have the freedom to use other money, such as Bitcoin," Poilievre said during a rally in March. Later that same day, the MP tweeted a donation link calling on supporters to take back control from bankers and politicians and to make Canada the blockchain capital of the world. Now, we'll see what happens, but it's very interesting to see someone in the highest level of Canadian politics. I mean, the rival to Justin Trudeau, to such a rival that Justin Trudeau felt the need to specifically call him out. It's a political rival, potentially someone who would be vying for his position as prime minister. So, it's a big deal to see someone like that being a proponent of Bitcoin and talking about it on a public stage like this. So, very, very big deal. Bitcoin, crypto, I guess, is really starting to hit the mainstream in a more serious way. I mean, up to the political level, which is crazy.
Yep.
All right. And final story. So Maker, which is the issuer of DAI, the stablecoin, raises staked Ethereum limit to reduce reliance on USDC.
Say what?
So Maker, the DeFi protocol behind the DAI stablecoin, announced that it has doubled its debt ceiling on its staked Ethereum vault. Maker is working to reduce its reliance on centralized stablecoins such as, I don't know why it says center, it's Circle's USD coin, especially after the mid-August Tornado Cash scandal. So Maker is looking to unwind USD's influence and the proportion the token holds as collateral to DAI, the crypto's lending service's own decentralized stablecoin pegged to the US dollar. By approving MakerDAO's governance proposal to raise the debt ceiling to $200 million, the protocol expects to see more ETH deposited against DAI, reducing its reliance on USDC. So DAI, for those who don't know, is a stablecoin. The way it works is it's collateralized. Unlike some, it's not like, UST, Luna's fiasco stablecoin. It was an algorithmic stablecoin. DAI is a collateralized stablecoin. So it is still through a DeFi protocol, Maker, and what you do is you post collateral like ETH or USDC or something else, and then you can mint DAI, so mint this stablecoin. And the important thing to remember is I believe it's over collateralized. I can't recall the extent to which it is, meaning imagine like a loan to value ratio of like you put up collateral of $100 and you are able to mint $50 worth of DAI. So that would be over collateralized by like 2 to 1, and that is how you help avoid some type of crazy margin call or just a problem with because the collateral backing it can fluctuate, and if it fluctuates where there's not a one-to-one relationship, then the stablecoin itself, the value of it gets called into question, and that can lead to problems similar to the Luna UST fiasco. So that just kind of explains what this is, how it works. So it's a collateralized stablecoin, and what Maker is doing is basically changing their limit on how much ETH you can post as collateral. That way, it encourages more ETH, and they're kind of discouraging USDC because they're worried that the regulation, centralization concerned around USDC because of them kind of, bending the knee to sanctions and the treasury. They want to get rid of that because they think that it is a risk. They're a DeFi protocol. They want to get rid of centralization. They don't want to be reliant, have their quote unquote decentralized stablecoin reliant on USDC, a very centralized and sanction friendly stablecoin. So that is just kind of the gist of what this situation is. So the Tornado Cash development factored heavily in MakerDAO's parameter change proposal on August 25th. Its analysis on the lending market explained the US OFAC agency's imposition of sanctions on Tornado Cash smart contracts could indicate increasing risk for direct holdings of censorable assets such as USDC. Crypto services have seen heightened concerns surrounding USDC as a centralized asset in relation to Tornado Cash. Maker's collateral ratio still relies heavily on USDC to back DAI despite recent developments. So yeah, this is on the back of the Tornado Cash thing, because that's what the U.S. sanctioned, and Circle, which runs USDC, kind of abided by that. They said, okay, we'll sanction that. We won't let people use Tornado Cash. And so ever since then, people have been really calling into question USDC or other centralized stablecoins entities because they don't want censorship, right? And people in the DeFi world, at least those who really care about it, that is part of the ethos. And so they're trying to slowly transition, unwind their USDC position, and figuring out ways to replace that, or because you got to do something. You can't just take it out. You have to encourage people to replace that collateral because it's a meaningful part of the collateral that's used to back DAI. So they're trying to encourage people to post more ETH, and discouraging people from posting USDC so they can fully unwind that position.
Totally.
So the market may finally start to reward decentralization to the point where risks are acceptable because USDC is no longer the no-brainer it used to be. So the reason people were tolerant of stablecoins like USDC, USDT, all these centralized ones, is because they were safe, they worked, and especially after UST and Luna, people were like, okay, well, I can't risk that. I mean, it's not backed by the government, like FDIC insurance. I'm not going to get my money back. There's a lot of risks. But some people are saying it might be worth the risk because of the regulation and treasury or federal government oversight of USDC and other centralized coins. So ongoing news surrounding Tornado Cash and Circle's wallet blacklisting have only increased the urge for less USDC to be used on the Maker network. Maker's usage of ETH is their latest attempt at unwinding their USD collateral. Yeah, so pretty big deal. Not sure how this is going to affect the USDC dominance, if people are really going to start not using USDC. Maybe there's going to be another stablecoin emerge. Who knows? But still, very, very meaningful development. All right, but that does it for these stories. But before I get out of here, I'm going to go ahead and talk about what we can look forward to next week. All right, so next week we have, actually this is later today, we have Japan balance of trade and Australian unemployment numbers. If anyone cares about those, thought I'd mention it. And then tomorrow we get US, UK, and China retail sales for August. We also get China industrial production numbers. And then next Monday, Japan releases its August inflation numbers. The previous month was 2.6%, and there is no forecast, unfortunately. What? And next Tuesday, we get Canada's August inflation numbers as well. The previous month was 7.6%, and the forecast is 7.5%. We also get U.S. building permits and housing starts on Tuesday. And that is going to be a big deal because, a lot of people talk about how the housing market is the economy. So if housing starts are, declining, that just could be a sign that the housing market is really starting to teeter. And I'm personally hoping housing prices come down a little bit as a hopeful future home buyer. But we'll see. So definitely want to look at those building permits and housing starts on Tuesday. And then on Wednesday, so I will be covering this in my next Hump Day update, but on Wednesday, the Fed delivers its interest rate decision. The current rate is 2.5%, and the forecast is still another 75 basis point hike. Though, as I mentioned earlier, the market is currently pricing in a 30% chance of a 100 basis point hike. Now, obviously, that will be data dependent, so anything could change, and I will stay updated on what the market is pricing in. But yeah, prepare for either at the moment 75 basis points or 100 basis point hike. And out of all these things, that is the one to remember. Next Wednesday, the Fed delivers its interest rate decision. But that is all I have for you today. Aww. So on that note, stay happy, humble, and most importantly, solvent. And I'll catch you all next week.
And we say bye-bye.